figure out what the medium and the long term actually holds for our markets amidst all the uncertainty. We've got Amish Shah from Bank of America joining in on the show right now. Amish, hi, great to have you on the show. Thanks for your time today. Wanted to understand, how is it that you're mapping the market construct? I mean, first you've got a completely committed government and a central bank. They're doing whatever it takes to try and propel demand back into the economy. And then on the other hand, you've got that big question mark on whether or not Trump is going to chicken out this time or not. For now, at least, we're working with that 9:31 a.m. come tomorrow when India is going to be slapped with 50% tariffs. Amish, what's your reading of the entire situation?
Good morning, Aisha. Thank you for having me on the show. So look, I think even keeping aside the tariffs, the fair value for Nifty for the end of this year, we think is 25,000. Given that Nifty is broadly at these levels already, we think that the incremental upside for the rest of the year is very limited. Obviously, to your point, basis the incoming news and developments, markets will have volatility. So tariffs is a part of that volatility. So we think that in the best case, there can be a 4% upside from current levels. In the downside case or the worst case, there could be 11% correction to Nifty from current levels. Broader markets, in general, we have been arguing are quite expensive. They have underperformed. We think will continue to underperform the large caps. So that's not a space that we are particularly excited about, barring some bottom-up themes out there. So broadly, our feeling is that markets will rally in between the two earnings season on the back of hopes. But earnings will continue to get disappointed, and during the earnings season, therefore, you will see continued correction.
But Amish, why that 11% downside premise? Wouldn't you have thought that the markets would have already priced that in by now?
So 11%, as I said, is a worst case downside. That would mean coming together of a few factors. So the first is tariffs. Nobody in the market expects that 50% tariffs will stay for longer. It seems like a negotiating tactic. It seems that, we will come to a normalized level of 20-25% over time. But what if they continue for longer? That's one downside risk. The second source of worry is prior to President Trump coming in the US, the effective import tariffs of US was 2.3%. Now it has gone up to 16%. And our sensitivity suggests that every 500 basis points of tariff in the US is an impact of 30 basis points on their GDP growth and a 30 basis point increase in inflation in the US. So given that we've gone from 2.3 to 16, that potentially means that there's 100 basis points of downside risk to GDP growth in the US and an upside risk of 100 basis points of inflation in the US. That could potentially slow US GDP growth, and if that happens, US market corrects and it has a cascading impact on India as well. So a combination of those two factors, I think, can have the worst case scenario play out, but that's not our base case as of now.
Right, and Amish, hi morning. This is Nehi also joining in. Just to follow up on that, while you very nicely explained why was 25,000 number, on the flip side, on one side we do have tariffs to worry about, but look at all the push that's coming from the government in terms of GST rationalization, from the central bank in terms of the rate cut that we've seen recently, and also the festive season that's up ahead. 25,000 is almost where we are at right now. In the months to come, do you see no upside to Nifty given so many positives are also in the anvil for us?
So, Sneh, look, all valid points, and I completely, think that the government is doing the right thing. They are very proactive with their policies. Obviously, from a market's perspective, we have to look at what's already priced in the valuations. So, despite all of the factors that you spoke about, we are of the view that there will be a recovery in earnings growth and GDP growth, but we think that the recovery is going to be shallow in comparison to what the markets are already pricing in, whether it's about consumption or it's about Capex or credit growth or GDP growth or corporate earnings growth. On all parameters, we think that there will be a sequential improvement or an uptick. However, it will fall short of expectations. And that is one reason why we think earnings continues to get downgraded. problem one. Problem number two, as you know, there's plenty of paper supply or fundraisers that are expected. We have seen $30 billion of fundraisers so far in this calendar year. There is another $30 billion of IPOs coming up, and there is another $20 billion of stock that was in a lock-in period, which is going to expire in the next couple of months. And once this lock-in expires, there is a large part of this paper supply coming into the market. So all of these, we think, will keep the markets constrained or capped at 25,000 levels.
Sure. But Amish, let's talk about earnings. The point that you were making right now, that the pressure on earnings is going to remain. If I were to take Q2 as a premise, while there were no big upgrades, there were no massive disappointments either. There were sure a select few, and IT has clearly been the front runner in that, or at the bottom of the pack, whichever way you want to term it as. But where is it that you sense that there's going to be continual strength?
So Aisha, think of it like this, that if you look at the consumption pack, the government over the last 12 months has given a cumulative $48 billion of stimulus. This is through $24 billion of additional subsidies, mostly coming from the state governments. And then you had $12 billion of direct tax cuts announced in February budget, and potentially a $12 billion coming in from GST cuts. So you have $48 billion. Now the markets have assumed that all of this $48 billion will equate to consumption growth picking up. The problem is that when we do our checks, we think that a large part of this $48 billion will be used by the consumer to replenish his lost savings since COVID. Some part of that will go towards retiring the expensive loans that they have taken from MFIs, and only a part of that will go towards actual consumption growth. So that's the source of disappointment. When you look at the Capex, clearly, given that Capex was primarily driven by government, and government earlier was cutting subsidies to do more Capex, now that equation has reversed, where the government is trying to balance Capex as well as consumption growth. So the more that $48 billion that you have given towards consumption, to a large extent, comes out of the Capex pool, and as a result, we think there will be sources of disappointments in Capex growth as well. And then when you talk about the credit growth currently is around 10%. We think will go to 12, but the markets are expecting it to go to teens or mid-teens, more accurately. That kind of demand is just lacking. The corporate India is sitting with $60 billion of cash on its books. They just don't need that kind of loan capital to grow. And while there is a lot of demand for credit on the unsecured side, given constant NPAs, the banks don't want to lend there because you can get credit growth from unsecured right now, but it will lead to NPAs later. And finally, where it comes to the secured categories like mortgages, there is not too much of NIMs to be made on that loan. So then there is going to be a struggle of if you get loan growth, then you have to worry about NPAs, or if you get loan growth from secured, then you have to worry about weaker NIMs. So all of these things put together, to my point earlier, that yes, there will be a recovery, but the recovery will fall short across consumption, Capex, and credit growth. And as a result of all of these put together, we are looking at weaker than expected consensus earnings growth as well.
Right, okay. Amish, appreciate that view, and I was just going through your latest fact sheet. Some upgrades that I see, some spaces that you're positive on. From underweight, IT has been upgraded to overweight and utilities to neutral. Give us a sense of what's driving the conviction here when it comes to IT. Is it only the underperformance that we've seen for so far? Is that why you expect IT to do better? Or fundamentally, are you seeing more value emerge here?
Sure. So, Sneha, the first point I will make is that obviously if you're a long-term investor, to my point, Nifty is at 25,000. The fair price is 25,000. So there is not too much money to be made if you just continue to invest and forget. But we think that if you're a nimble investor and if you're able to play the market volatility, in other words, buy the dips and sell at rallies, so that's one strategy. And the second is that if you rotate within sectors, there is a potential to generate better returns or alpha. And IT and utilities is a part, meaning in fact, we have also upgraded consumer discretionary, some stocks. So that's a part of that strategy. So IT, you are absolutely right. We don't think that there is too much of fundamental structural growth improving yet. But from a positioning perspective, massively under-owned sector, valuations have come off, all the negatives are already known, and therefore there is earnings visibility, and that is just good enough right now for the sector to rally. Where it comes to power utilities, again, we were bearish for all this while because we were assuming that yes, there is power deficit in India, but the supply will take time to come up, and therefore there will be execution delays in adding capacities, which was not priced in. But now that the stocks have come down by 30-35%, we think that the large part of that execution worries is in the price, and therefore these stocks act as a very good defensive in a volatile market, plus they give you good dividend yields. So that's the reason for the upgrade. And some pockets of consumer discretionary, even before the GST cut, we think that the valuations had gone sensible. There were structural themes driving these sectors, so things like building materials, consumer durables, travel and tourism. Some of these pockets, has good legs of growth or structural themes, and GST only helps as an added advantage as a news. So some of these things, if you just keep rotating within what is working or what is giving visibility of earnings growth in the near term, I think that's the way to make money.
But Amish, isn't valuation a concern in some of those pockets? Travel and tourism, QCOM, or for that matter, even aviation, which could be also a way to play consumption?
There is, and unfortunately, there is nothing which is left as value in Indian markets anymore. So nothing's available cheap. Everything's expensive. But the thinking then is that if you have sectors which can demonstrate or have visibility of earnings growth, then markets are unlikely to penalize these companies only on the back of valuations. So in an environment where everything is expensive, you at least want to go after growth visibility. And some of these pockets that I mentioned, we think will continue to offer that earnings growth visibility.
I'm also quite intrigued, Amish, by your overweight on some of the Capex themes. I don't know if there's been a change since. Defense, shipbuilding, power transmission. But when it comes to Capex, rail, road, metro, ports, power distribution, logistics, cap goods, that's all underweight.
So Aisha, again, to my point, by and large, Capex growth in India is going to come off. So to put some specific numbers, between FY21 to FY24, overall Capex growth in India was 20%, when you include private, government, all sorts of Capex in there. That 20% in FY25 came down to 9%. And markets believe that FY25 growth coming off was an aberration, because the government was busy with elections, there was plenty of rains last year, and therefore the market's belief is that 9% will scale back up to 17%. Unfortunately, we don't think so. We think that structurally Capex growth in India is now going to expand only from 9 to 11%, and 11 will therefore fall short of the 17% expectation, and which is why bulk of the Capex stocks we are negative, including cement. That said, coming back to my point earlier, that there are some pockets where we think that there is growth visibility, and while the valuations are expensive in those spaces as well, defense, shipbuilding and power transformers are three sectors where valuations are rich, but the growth visibility is quite high, and therefore relatively within the Capex space, we will continue to be overweight on defense, shipbuilding and power transformers. We are bearish on the rest of the Capex space.
So you're saying basically, Amish, that even if valuations are a little frothy, go for growth, right? Because there's nothing cheap in India.
Absolutely. So if you look at the last 9 consecutive quarters, the top line growth of Nifty companies, these are companies that you logically expect that will outpace the nominal GDP growth of India, because they are market share gainers. So if the nominal GDP grows at 10, most of these Nifty companies will argue that they will want to grow at 15%. But if you look at the reality, over the last 9 consecutive quarters, Nifty companies' top-line growth has been between 5% to 8%. So they are struggling to grow even at the nominal GDP growth of India. So in an environment where growth is challenged, clearly investors will have no choice but to pay up for valuations where there is growth visibility and higher than nominal GDP growth.
Right. Amish, so another thing that stood out to me from your latest fact sheet is your view when it comes to quick commerce and e-commerce as broader themes of the consumption basket. While you're positive on quick commerce, there's an underweight coming in on e-commerce. Could you help us understand what's driving this divergence, since both of them are new age levers to traditional consumption? What is at play over here?
So quick commerce, you would recollect, there was a scare about increasing competition from a variety of players. That has dialed down, and that has helped these companies demonstrate good profitability growth in the last couple of quarters, and we think will continue to going forward as well. Whereas a large part of the e-commerce space, competitive intensity has only gone up. Earnings have continued to get downgraded. For example, the beauty space. So variety of the e-commerce players are actually seeing or witnessing increased competition, lower than expected profits, earnings downgrades is a reason why we think markets will now start to differentiate between where there is growth visibility versus where growth is still a struggle.
Amish, one last question before we let you go. You've given us the premise for what you feel that the index is going to do in both the best and the worst case scenarios. Is it also the time to make those calls based on market caps? What happens to Smiths, for instance?
So Aisha, mid caps, are very rich. By and large, for the last 12 odd months, we have been bearish on mid caps and small caps. To some extent, they have already underperformed by 600 basis points over the last 12 months to Nifty already, and we think that that underperformance continues. Having said that, earlier we were bearish everything small and mid caps, and now after the correction, there are some small pockets of opportunities that have started to emerge. So we have started looking favorably small and mid caps within building material space, consumer durables, travel and tourism, and auto components. So these are 4 pockets of opportunities that have started to emerge. But by and large, we think that small and mid caps will continue to provide negative returns and will underperform the large caps, therefore.
Right, and Amish, very quickly before we let you go, we understand there's a BOFA downgrade coming in on pharma stocks. Could you help us understand the rationale?
The specific stock that you were mentioning, so first of all, we are not so optimistic on anything which is exposed to the global growth or external world. So generic pharma is something that we do not like. We are more positive on hospitals, which is more domestic-led story. And the downgrade, particularly is the US generic exposure, and over and above that, the share of the specialty business which was driving the stock so far, we think now has peaked, and therefore incrementally we think that the valuations will come off or the valuation premium will shrink.
Got it. Amish, so good having you on the show. Thank you for your time.
My pleasure. Thank you, Aisha.
Okay, let's move on. We've got lots of food for thought when it comes to equity markets from the House of Bank of America, but PM Modi